So I don't know about you, but personally, I get pretty excited whenever someone shares his or her portfolio with me publicly or even privately. Don't focus on what they say, but look at what they do. So this is exactly the purpose of this video, where I'll walk you through my current thought process, do a comparison from 1 year ago at the start of 2024, how my portfolio has transpired, and also to log some of my internal thoughts, observations, and analysis in real time so that I'm not stating the obvious, especially when the event has happened. So of course, do stay tuned. I think at the later part of this video, I'll be sharing my exact position, what was my cost price, how many positions do I have, and the exact detailed breakdown. So this is the snapshot of my current portfolio holdings, accurate as of 20th of Jan 2025. So if you're just interested in the general holdings of my portfolio, you can take a screenshot here and then you can click away. However, for those of you who are more interested in a specific breakdown and details, I've prepared quite a bit for you. I think first things first, when a new person, a new layman steps into the investing world, he's oftentimes confronted with a few big ideologies or a few big philosophy. And I think in the investing realm, this idea of long-term investing comes out a lot. And there is always a very stark contrast between investing versus trading. And one important factor is always in terms of the holding period. So for myself, I think when I look into the idea of long-term investing, especially so in this very crowded environment or crowded market where you see many people stepping up and they do share their journey online publicly, and I do respect them for that. However, I think a main qualm that I have whenever somebody say that they talk about long-term investing, value investing, so on and so forth, is that you can look at the actions and sometimes they hold a stock, it appreciated by 20, 30, 50%, and then off they go. They sell the stock and then they move on. And then they tell you that they're a long-term investor. But you've never seen them hold a stock for more than a year. Unless the stock went into the opposite direction of what they've expected. Then there is another term called you're stuck back holding. Here's my first entry for every single position in my portfolio. And I think the longest, for those of you who have followed me since the start, the OGs, I've held Alibaba for close to 1,500 days. And guilty as charged, I sometimes joke around saying that I'm back holding Alibaba. And I think the main point here is we don't want to trap ourselves into specific labels or categories. I'm thinking that, just because I'm an investor, that's why I have to hold my stock all the way until it goes to zero. And the broader point here is to always fine-tune your investment process and to abide by different philosophy and rules around this whole investing game. Rather than saying that, because I'm an investor, I cannot sell a stock because I've held it for less than X amount of days. So for myself, I think I just wanted to share this in the name of transparency and accountability on looking through my own journey, how long I've held the stock for, and kind of get the gist of my idea of what I mean by long-term investing. So to be frank, I think if the company is still executing well, your thesis is still generally intact, and they're not egregiously overvalued, like 3 times, 4 times above your intrinsic value, I think they're still good long-term holds. And as long as these companies continue investing in great projects, get a better return on their investment, on their cost of capital, they're able to compound your capital at a much significantly higher rate. So after looking at my current portfolio holdings, I just want to do a kind of a side-by-side contrast, comparing it to 1 year ago. This is accurate as of 17th of Jan 2024. And I think the biggest thing that jump up is probably the portfolio returns. This is a simple return. It's not CAGR, it's not IRR, it's not money-weighted return, time-weighted. It's not all of that. And I think specific to the finance industry, it's populated by very smart people coming up with many different ratios, metrics to track, and of course with their own very good reasons and logic behind them. But as a layperson, I think most of you are just interested in knowing what is my simple return, meaning how much money I put in and currently what's my portfolio value at. I just do a division, and that is basically the X amount of dollars that I earned, quote unquote, on an absolute level. So I do track my own so-called CAGR or IRR, and at the same time, I do a simple calculation. And I think 1 year ago, it was probably at one of the lowest state. I was still down 17%. And unfortunately, in the latest update, I can see some sort of a green return over 3-4 years time frame. And I think the largest contributor, if you look at it on a portfolio level, is really my top 3-4 positions that will move the needle, because I do run a pretty concentrated portfolio. So I think just a few high level numbers to get you up to speed and appreciation of my own portfolio breakdown. So the portfolio market value has swung from 97,000 to 174,000. And I think the first instinctive reaction is to say that, maybe you contributed a lot to the portfolio. And based on my record, roughly 38,000 is by contribution over the last 1 year, and the other 40,000 is purely due to market volatility or the returns of the individual positions itself. And here is the 2 screenshot of my larger accounts. I do have a few small accounts here and there, but yeah, I think they mainly kind of reflect the performance that I've experienced over the past 1 year or so. So I think they're still okay. I mean, if I can say so myself. So regardless of how you spin it, I think it's quite obvious that I still have an outsized exposure to some of these Chinese names. And so whether my portfolio tanks or go to the moon, I think it's really reliant on some of these major names that I've positioned myself into. And as I have alluded, I think judging on an allocation basis, there are only a few names that can really move the portfolio, and they have kind of staged a comeback to varying degrees. And these 3 main buckets consist mainly of the Chinese tech, which is Baba and Tencent, the Max 7, which is the 3 names that I have, and the last part, which is semis, which is TSMC. So let's talk about some eliminations when I put the 2 portfolios side by side after a 1-year transition period. So the first one is, of course, Chinese banks. You can see that China banks were the 3rd largest position, sitting at 9%, and then in my latest update, I have actually sold them. So for those of you who are interested, this is not my first time talking about China banks. Actually, I wrote about them extensively on my Substack. Feel free to join them. I'll leave the link in the description below. But I don't want to belabor the point. You can read my 2 episodes or 2 entries that I've put in the middle of last year, roughly in the July period, specifically in these 2 blog posts itself. Now, on the second elimination, I wanted to talk about the REIT asset class. So I did have exposure in CapitaLand and Fraser Centrepoint. Third position that I added sometime later in 2024 as well, which is Parkway Life REIT. But I think moving into 2025, or at least in end 2024, I've actually sold out all of those positions. So my main gripe or my main arguments around why I sold them is mainly because it might be it's not you, it's me problem. Don't worry, it's not the relationship drama here, but I think it's more so a wrong stage of life. I'm not very interested in focusing in the dividend asset play, so I focus more in terms of finding or hunting for undervalued opportunities, looking at quote-unquote growth stock or growth at reasonable price. So looking at some of these dividend counters or real estate investment trusts might not be my preference at this current life stage. Secondly, I think I don't have a particularly strong interest for these REIT companies other than mean reversion. But I think based on my experience, it has been proven pretty tough to try to time the cycle, especially this upcycle. It's very noisy and hard to distinguish between noise and signal. And there are quite a lot of different theories being put out there on how these REIT asset classes will perform in relation to the broader Singapore economy, the interest rate hike cycle, the rental reversion, mean reversion, valuation play, the dividend policy, etc., etc. So initially, I might have underestimated the entire asset class and think that there are just a few moving parts, but it has been proven otherwise. So for myself, I don't think I have a strong preference in particular names. So I tend to try to diversify across different sectors and industries. It has kind of evolved into becoming a chore to both monitor and to research for new ideas and new picks. My takeaway is just that the ROI, the return on investment of my time, is not very well spent on this set of stocks. And I had a particular thesis going, which is when I was trying to time the interest rate cycle, and it didn't turn out as expected. So yeah, that was generally why I exited this position. So this was from previous presentation on why I sold REITs. So mainly I've talked about the mean reversion, the rate cut cycle, and the dividend irrelevance camp. And if you were to do just some simple comparisons in today's market climate, I do think that there are better places that I'm more interested in putting my capital into, rather than the REIT asset class. So the third bucket where I've eliminated some of these US names, including SPGI, which is S&P Global, HSY, Hershey's, and TMO, Thermo Fisher. So the first thing that a lot of investors like to look at is the price performance. So how have they performed over the last year? SPGI up 13%, Hershey's down 19%, and Thermo Fisher relatively flat. So in case you haven't been following me, this is just my own personal style. You can do otherwise, but for myself, whenever I hear of a new name or as I continue to build my conviction, do my homework, and to follow the company's earnings and development, I tend to like to add to starter positions, meaning to say these companies will make up less than 1% of my portfolio. I'll add them first so that I have skin in the game, and then I will then follow up with my own valuation model, look at the company earnings, And I slowly built my position as and when. And if I were to go back to the holding period that I've shown just now, you can see that it's just natural that the longer you hold a particular position, the greater the percentage of the portfolio. So I'm not the type of investor that will hear of a new investment thesis and then immediately bump the stock up to like 20-30% of my portfolio. So I tend to like to play around with some of these starter positions that are in my watch list. They seem to be relatively undervalued, and I want to first have a small bite and to monitor them to have skin in the game. So firstly, I was cutting down the number of names in my portfolio. I don't want to monitor too many, so these three generally just took the back seat. Secondly, I think there's also a distinction between value and conviction based on what I've shared just now. So yes, I do believe that the market, regardless of how overvalued or how overpriced it seems, there are definitely opportunities everywhere. It's littered. It's just that in a general bear market, there tends to be a lot more opportunities, and in a raging bull market, there are lesser opportunities as the stock market valuations get extended upwards. But I think the second part of the pie, or the second part of the equation, is that people often forget different investors have different experience, different know-hows, different, insider knowledge or whatever you call it. And most importantly, all these are fundamental building blocks to build up the conviction of the investor. So like myself, I'm extremely bullish on Chinese tech, and a lot of people will think otherwise. So they are often very skeptical of my allocation. But just do know that conviction cannot be borrowed. It has to be built within. So each of us have our own arenas or conviction that we are comfortable playing in, and you just allocate your portfolio accordingly. Somebody can tell you that X or Y stock is the most undervalued name. It has the best risk-reward opportunity in the market today. But don't forget, the conviction he built and he has managed to develop over the years is definitely different compared to you. So you as a new investor coming in, you can hear a lot of people talking about many wonderful investment theses or companies to invest in today, but it does not mean that you should go all in with your portfolio and you have to play to your advantage. I think that's just something that tend to get muddled away, or people just tend to forget about it. So don't get me wrong, I think it's good to always have new, fresh investing ideas, but just do know of these two differences of value of a company, of an investment, and the level of conviction that you can hold to allow you to tide through the storms and to sleep through sleepless nights, especially when the company is tanking. So that's the second point. And lastly, I think if you've guessed it, some of these names, they're thrown at me. I personally have not made much progress into deepening my understanding in them. That's why I've cut all three of them out of my portfolio after a year. Now, let's move on to the additions of my portfolio. So the first one that stand out is definitely Multi. Those of you who are interested in why I invested into Multi, you can look at the second half of this video. I did walk through my entire investment case or my expectations for Multi, so I won't spend too much time talking about them as well, but I do think that they are really an exceptional company. Even though it's a state-owned company, it has exceptional quality, so its company's fundamentals have been growing from strength to strength over the last 5 to 10 years. And I think valuations have been beaten down across the board for most of these Chinese names. So I've picked them up after a few months or years of consolidation. And just to round up over the past 1 year, what positions I've added to. So Multi, denoted by this green arrow, is a new addition of the portfolio. Secondly, I've also added around 100 shares of Tencent. I've added to Amazon. I've double added to Google. I think I've increased my position significantly. I've added to Meta as well. I've also significantly increased to LVMH. I've added Lulu. It's a new position. I've added to Haidilao, and I've added to Adobe, and I've started a new position to Oxy. So I think just to give you a quick idea here, you can see two double yellow arrows on Google and LVMH. So naturally, if you look at both of them, they have not been performing very well over the last 1 year, which is why I look at it as some sort of a window for me to be adding to their positions. And also the three names that I've added, Multi, Lululemon, maybe except Oxy. So for both Lulu and Multi, I've made specific videos on my investment thesis. For Oxy, like I said, I think whenever you look at positions under 1% of my portfolio, they are starter positions. I'm monitoring them. So considering that you have the full numbers of my entire portfolio today, I feel kind of naked of my financial situation. But I guess that's the job description of being a content creator. So with the privilege of being a content creator, I've managed to secure a KOL exclusive with Mumu. So for new users to Mumu, you can now head down to the link below to potentially huat big with 3,154 Singapore dollars worth of ang pao deals up for grab. Generally speaking, all you have to do is to deposit at least $100 and do one buy trade to get the $20 cash coupon. And you can see that there are varying tiers of the different user rewards. So you can deposit at least $3,000 and do 3 buy trades and get zero point 0.1 Tesla stock, or deposit 10,000 and do 8 buy trades and get 0.4 Tesla stock. So you can get up to 1 Tesla stock if you deposit a total of 100,000 Singapore dollars. Additionally, if you deposit a cumulative amount of at least 3,000 Singapore dollars, you can get an entry ticket to a Chinese New Year Ang Pao lucky draw with a 100% chance of winning. So for existing users, don't worry, they haven't forgotten about you. You can now look through the different bonus tiers when you deposit fresh funds into your account. And at the minimum, if you deposit at least $10,000 worth of fresh funds and hold it for 30 days, you can get $30 worth of trading cash coupons. So for the first 30 days, I've already deposited in my own account and I've already redeemed and used my $15 worth of trading cash coupon. And for the last group of you who have already created a Mumu account previously, but have not done your first deposit, don't worry, you can now get your special reward by following the few steps, which is go into the search function, type in special deposit, and key in the promo code, which is CK88, and do your first deposit. And thereafter, you can still enjoy the Mumu Exclusive reward and the Chinese New Year related Ang Pao deals. And this is just an announcement for those of you who have yet to take advantage of Mumu's Chinese New Year promotion. Now, back to the entire portfolio review. So in the last part of this video, I'm just going to outline the main reasoning or thesis for some of these major buckets of investments that I can kind of categorize them. And firstly, of course, we have the Chinese tech exposure. So cumulatively, you can see that they make up roughly 40+% of my portfolio. And I still remain an extremely big Chinese tech bull. So in the last 4 years, I've been tortured, I've been punished, I've been ridiculed, whatever, insert adjectives here. So I think when looking at these two companies, you can adopt a very simple framework, at least two frameworks here. Firstly, you can look at it from a risk-reward perspective. Secondly, you can look at the company fundamentals versus valuation perspective. So when you talk about risk-reward, I think I've outlined my thoughts in multiple videos already, talking about what the associated risks accorded to many of these Chinese listed or Hong Kong listed companies. Yes, I do think that fear is being overblown. They talk about VIE structure, all those. I recognize the fact, but I don't think that I wouldn't accord them to a very high risk level. But that said, I think when you look at it on a macro level, I did talk about the pain tolerance or threshold of the Chinese government, and looking at it from a risk-reward point of view, the risk meaning the downside, I do think that at the state of the economy, the stock market, and how the companies are performing today, you kind of have a flaw in terms of valuation. There's a capped downside. Price might go down or valuations might continue to deteriorate. Never say never, but I don't see a 50%, 60% drawdown after this whole 4-year long bear market or downturn. When you look at the potential reward, let's not forget that we are still in a broader, very bearish kind of sentiment, both from an economy point of view and from a company valuations point of view. So just a little bit of re-rating, a little bit of recovery, a little bit of just things nudging in the right way, there is probably a very long growth runway ahead. And not forgetting a lot of your AI, technology, communication services talks. These two companies are basically primed for the following decade of tailwinds of growth. We talk about fundamentals versus valuations. I think valuations is the easier one to square away. Alibaba is probably still extremely undervalued. Tencent, I think a lot of people might argue that they kind of go back to fair value territory. I think when we talk about fundamentals, let's also not forget that some of these companies, they are the prime companies in the Chinese tech real estate. In the tech companies specifically, I think Tencent still holds the crown. So looking at how the company has developed and performed over the last 3-4 years, recovery is well underway. They have been one of the better performers out there. So you can see that the share price is also climbing in lockstep. So on the flip side, I think fundamentally speaking for Alibaba, there's quite a few headwinds or challenges from the competition to the investment portfolio, to the whole restructuring and the entire overhaul of the management team. So I do look forward to how they're going to turn around this entire situation. But generally speaking, I think as a technology stack, as a portfolio of company that they do run, and the broader China economy today, they are quite primed to take advantage of the many tailwinds in the decade to come. Although there are a few missteps here and there, I think considering the valuations that the market is according to the business today, there is a considerable amount of margin of safety in how they govern their business and how they turn around the entire situation. And also not forgetting, I think both companies, they have been extremely shareholder friendly over the last 2 to 3 years. So they're giving out special dividends, they're buying back shares aggressively, and even Tencent is giving out some of their investment portfolio companies like Meituan and JD. Just a side note also here, specific to the Chinese tech industry, I think with my recent trip from China after coming back, I am re-evaluating my thesis around Meituan. Initially, I was not very optimistic about them, but considering the entire ecosystem of the tech companies and the app industry, I do look at Meituan quite favorably now. Of course, it has to be backed by numbers analysis and valuations as well. But I think just to share my real-time thoughts, Meituan is definitely in my watch list. I also do get quite a bit of comments from other investors asking me about other tech companies like JD, Baidu. They also look dirt cheap. I definitely do have my own concerns, but mainly for many of these Chinese tech names, I think valuations is mostly not the concern, but mostly from a business fundamentals point of view. So yeah, I'll just leave it as that. Second part, talking about China consumption, both Haidilao and Maotai, they are in the discretionary space, especially for Maotai, they're in the ultra discretionary, the luxury space. So there are news already being floated out that Maotai is slashing prices. I think demand is waning. So judging from the nature of these companies, you are really kind of betting on the China consumption recovery. So in the third bucket, you have the US tech companies and the semiconductor space. I think you don't need a lot of introduction. The Mac 7 has led the rally. On top of that, you have some of these semiconductor companies, probably except Intel, that has also been performing quite well. But there are definitely individual nuances when you compare semiconductor manufacturing companies like TSM or the equipment suppliers like Applied Materials, ASML, and even behind the line, which is AMD and Nvidia. All of them play a very unique role, and their share price performance are generally on an uptrend, but there are individual nuances in the companies. But yeah, they have been dominating headlines and the space or mind share of investors, talking about AI, talking about tech. So I don't think I need to talk more about them. I am probably developing another video talking about why I only own 3 of the Mac 7 names. But mostly, I can tell you that they are just valuation concerns. I do think that they all have respectable business models and great fundamentals and moat. But yeah, I think I do intend to continue keeping my exposure to them. In the fourth bucket, I have the US discretionary, which is LVMH and Lululemon. But I think I just want to put a small addition to the category of these stocks is that they are also a China plus strategy. I think both LV and Lulu, they rely very heavily on the Chinese market. The growth outlook ahead really requires a lot of this Chinese consumption story or recovery to drive back up the share price again. I think yeah, it's a kind of an adjacent bet. It's not completely a China consumption recovery bet, but it's a China plus story. And lastly, you have others, which is Adobe and Oxy. So I have actually sat through the entire roller coaster with Adobe. It was up close to 50-60% at one point in time, and it has recently came back down again. So I'm interested in adding to my position as I continue to build my conviction and understanding of the company. And lastly, on Oxy, Occidental Petroleum is one of the crown prince of Warren Buffett. He has been adding aggressively. I'm not gonna lie, it's a copycat. I just want to see why is Buffett even so interested in the oil industry. So this is really just a starter position, a skin in the game. I'm not too sure. Maybe in 2026, at the start, when I do a portfolio update again, Oxy will be gone. But yeah, that's generally my take on the different reasoning and thesis of my portfolio in general today. Lastly, I do need your help. I do have a few video ideas in the midst of planning, but I want to know what type of content you'd like to see more in 2025. And I'm also going to explore more writing too. It's part of my New Year resolution as well. So the Substack link will be down in the description below. And of course, don't forget to hit the like button if you have already stayed until this far. So with that in mind, I'll see you guys in the next video, and hopefully 2025 will be a great investment year ahead for all of you investors out there as well. And I'll see you in the next video, but more importantly and hopefully, I'll see you guys on the moon. Goodbye.